Else has joined? Okay, perfect. So starting off chapter 7 here, getting a strong understanding of this. So firstly, we have what is working capital ratios. They're basically efficient. They basically see how efficiently a business manages short-term assets and liabilities. First thing. And working capital, money a company needs for its day-to-day operations is called as working capital. What is an operating cycle? Operating cycle tracks down how cash moves from inventory. That first you purchase inventory, then you sell it. That means once you sell it, it becomes a receivable because your customers have to pay you. And once your customers pay you, from that money you pay your suppliers. So payables. So how money moves through inventory, receivables, and payable. That's an operating cycle. What is business efficiency? How efficient working capital management is in your company, basically because it improves liquidity and cash flow in your company. Performance measurement ratios help assess operational performance and financial health. Then we have exam focus. Understanding these ratios is essential for working capital analysis. So these ratios are very important. Okay. Let's go through firstly what is working capital first of all, and then what is working capital ratios useful for. Let's go through this, Anjali. Very good. Okay. Yeah, second one. Cash flow moving between the inventory, receivables, and the payables. Perfect. All right. Next, we'll look into business efficiency. How have you understood this? Mm. Okay. Perfect. So that is pretty much about a base understanding. This is just from the first slide here that we have understood. And from an exam focus, it's important to know the meaning of these things. So in simple words here, working capital is in the short term how the company is managing its money. Operating cycle, how is the money flowing between inventory, receivables, and payables. Business efficiency is basically how efficiently a business is managing its working capital, because if they does manage it well, you will see liquidity and cash flow both will improve. Then performance measurement, basically if we measure the performance, it will help us to know the operational performance of a company, the financial health of a company. And exam focus, understanding these ratios is essential for working capital analysis. For working capital analysis, it's important to know these ratios. Okay. These are our 5 ideas under the first subtopic called as working capital ratios. So under the first subtopic called as working capital ratios, we have looked into the top 5 points here. That what is the meaning of working capital and working capital ratios. Okay. Then we've looked into what is an operating cycle, business efficiency, performance measurement, and exam focus. All these 5 things we've picked up from working capital ratios and the operating cycle. Next, we look into what are working capital ratios really. Under the working capital ratios, let's get a good understanding about this here. So working capital ratios measure the efficiency of managing current assets and liabilities. So current stands similar to short, correct? Short term or current. Okay, we read short term on top. Here we are looking into current. It's pretty much the same thing. Short term or current assets and liabilities. Okay. Next, what are inventory days? Inventory days shows how long term inventory is held before being sold. Before being sold, how is long term inventory held before being sold? Next, receivable days measures how long customers take to pay. In receivable takes how basically talks about how long customers take to pay. That is receivable days. Payable days, how long the business takes to pay the suppliers, and the cash movement. Together, these ratios explain how cash flows through the business. The same receivable days, payable days we had seen on top. Same thing over here. Okay. Let's go through all the meaning of all these 3 days here quickly, Angeline. How have you understood this? Yes. Perfect. Suppliers. Perfect. So that is the 3 top days that one needs to know. We'll look into it and from the formula perspective and just the topics to come. So take a second topic we have understood is what are working capital ratios. 3 kind of days we have looked into. We'll also focus on the cash movement, and basically it helps us to just understand how efficiently a company is managing its current assets and current liabilities. That is the biggest benefit of doing working capital analysis. Now coming to inventory holding period. Okay, so how did we understand inventory days here, Anjali? With the company, absolutely spot on. It measures the average time the inventory is held before the sale. Absolutely right. Inventory holding period. So let's look into the formula here. Inventory divided by CU, cost of sales, into 365. That's it. Easy. Lower the inventory days, the better, right? Why do you think it's better, Angeline? Very good. Very good. Absolutely. Goods is stuck inside the company only. Demand is not much. Company is not able to sell it. Absolutely right. So it's lower the better. Because shorter holding periods reduce the storage and the financing costs. So shorter the holding period, it reduces your storage cost, it reduces your financing cost. Next, inventory turnover. It indicates how many times inventory is sold during the year. Okay, inventory turnover indicates how many times inventory is sold during the year. Okay, how many times inventory is sold during the year? That is inventory turnover. How many times inventory is sold during the year? That is inventory turnover. How many times inventory is sold during the year? How many times inventory is sold? That is inventory turnover. How many times inventory is sold during the year? Like X amount of inventory company refills, sold, refills, sold, refills, sold. The entire inventory is sold how many times? What is the holding capacity of the entire outlet? How many times it's sold completely? That is inventory turnover. Next, interpretation. Faster inventory movement improves your working capital efficiency. Right? So if your inventory is moving fast, that is great. It's improving your working capital efficiency. Okay. If it's moving fast, it's improving your working capital efficiency. Okay. Let's just go through these three topics here. How have you understood this, Angeline? The one I've highlighted. Yes. 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 Perfect. Okay. And finally, faster inventory movement. Basically, it improves. It's a very good sign if your inventory is moving fast. So faster movement improves your working capital efficiency. So that is about the inventory period. Yeah, feeling good about the inventory holding period. Are we clear with this, Angeline? No doubts here. Okay, so let's look into these 3 days also. We clear with this, right? No doubts here. Okay, and this is just an introduction. We'll build on this. So moving on now, a detailed breakdown of inventory. So there are three kinds of inventory here. Okay, so any guesses here, Angeline? What could be the three types of inventory? Absolutely right. So inventory can be for a manufacturer in three stages, right? That could be raw material, work in progress, and finished goods. But for a retailer, ideally, it only finished goods most of the times. If you're a manufacturing company, you will have finished goods also, you'll have work in progress also, you'll have raw materials also. But if you're a retail company, pretty much you will have only your finished goods because retail it buys it from the wholesaler and then sell it. The retailer wholesaler generally only have the finished goods, but if you see a manufacturer, they will have all the three. So looking into all the three, raw material measures how long raw materials remain in the company before it is used in production. Work in progress, it measures production time before goods are completed. What is the production time before the goods are completed? That is work in progress. Finished goods measured how long products remain before sale. Before sale, how long the products remain. Production stages, each stage helps identify delay within the production process. So each stage basically helps you identify delays. So if you track all these, you'll understand where the delay is happening. That if the inventory is longer in a company, exactly you can see where exactly is it taking longer to start being used as production in raw material days. It's taking longer to get produced in work in progress. It's taking longer to sell, that is finished goods. So these are about raw materials, work in progress, and finished goods. Next, in the production stages, each stage helps identify delays within the production process. So each stage helps to identify delays within the production process. So by looking into the numbers of each stage, you can get to know where the slowing down is happening. And separate ratios will give a more detailed inventory. So if you break it down and then you study the inventory process of a company or the inventory days of a company, you will get a more clearer idea. Okay. So let's look into these three ideas here. How have we understood these 3 days here, Anjali? Uh, yeah, after it's fully produced. Yeah, perfect. Okay, so this is all about us understanding raw material. You clear work in progress. You've understood finished goods is just that after a good is completely produced, how long it takes for it to be sold. That's it. That is a finished goods days. Production stages also you have clearly understood. Very good. So this is all about the in the detailed breakdown about inventory. Okay, so let's just have one good look here, Angeline. Any questions here? Okay, now let's move into receivables. Now we have come to a good end from the inventory perspective. Okay. So this is all about inventory. So I think we are good with this, Anjali. No doubts in inventory. We are clear with it. You have also understood like the way you have explained. So I'm very positive and you have also understood. There's no reason why we cannot revise this today, Angeline. At least 5 to 6 times you have to revise this entire Excel file today. Okay, it's not much. It's in small, small bullet points as you can already see. And you have already revised it once with me only as I've asked you to explain it to me. You have already explained it to me, right? The best way to explain to learn something is to explain it to someone. You have already explained it to me, and I'm very positive that you have understood this. Okay, so nothing stopping you from revising it at least today. Okay, 5 to 6 times you have to revise this Excel file. Yeah, as you can see, everything is very short over here. It's very easy to revise. You can 5 to 6 times you can revise this. Okay, so as we go into the now deeper end of the pool, so these chapters you might not get that much time to spend with them. So today, if you go through it 5 to 6 times, you'll see that you'll have a very strong understanding about everything, and you should get a good sense of confidence, right? So first time when you revise, you'll feel yeah, okay, you know a little. Second time, you will know yeah, I know a little bit more. Third time, you're like yeah, now I have the clarity. Fourth time, you'll get confidence. Fifth time, you'll get topper level confidence. Yeah, okay. So give yourself that topper level confidence. Okay. So 5 times you try to genuinely read this through. Today you have done it with me. From today on, whatever chapter we do, on that same day, how much ever finished, 5 times you read it. You just see how confident you will feel about it. Okay. It's just about making sure that you do a little more than you're used to doing. Then you will see slowly how confident you will start to feel. So that is all about slide 3, slide 4. Now let's move on slide 5. Now we'll look into collection period. Okay, let's go through this, Angeline. I feel you're good with this also. Tell me. What is the collection period? What is the formula? Perfect. What does it tell you? Okay. Why is it shorter the better? Okay. Perfect. Now see what happens is I'll tell you what this thing means also reducing financing needs. So basically, if I had given you let's say 2 months to pay, during that 2 months, just think about it. Me as a business owner, I have to pay my rent. Okay, I have sold you some goods, Angeline, and I've told you that you pay me after 2 months. Now, if you logically think about it, during that 2 months, I will have to pay my staff salary also. I have to pay the rent of my shop also. I have to pay electricity bill also. I have to pay Wi-Fi bill also. I have to recharge my mobile phone also. Right? I need to charge my laptop, so I need electricity for that. So I have to, that bills also. So all that bills are there, and you will pay only after 2 months. Correct. So for those 2 months, how do you think I will run my business? I need to buy more goods also from the supplier. Even he's asking money, or I need more goods because new customers have come that you would have recommended that yes, whatever t-shirts I'm selling is very good. So at least 5 more people have come to buy t-shirts from me. So I should have those t-shirts. So I need to place an order with my supplier also. So basically, I need money, but you will pay me only after 2 months. Correct? You will pay me only after 2 months, but during those 2 months, don't you think I will need money to run my business? Right? And every customer I'm giving 2 months. So everyone will pay later only after 2 months. So now how do I run my company? Where is the money coming from during that time? Whatever money I had, that I purchased the goods. I purchased t-shirts and then I sold it to everybody. So whatever money I had that has gone in purchasing. And then I sold it and I gave everyone credit period. So I don't have any money technically if you think about it. Yeah. Are you with me with this example, Angeline? Are you clear? Whatever money I had, what did I do with it first? I bought the t-shirts, very good. And then what I did, I sold it to the customers. But did I get the money immediately? Correct. So 2 months later, I'll get all the money. But would you agree, in the interim, no money is left with me? Correct. Would you agree, I'll have no money in my bank account right now? Because where has all the money gone? Purchasing goods, absolutely right. Setting the shop up, right? I bought a shop on rent, I gave deposit. Then got all the goods, I paid my supplier. Then I needed electricity, little lighting, little setup. So all the money is gone now. So I don't have anything right now. And all the customers have sold, they'll pay only after 2 months. So in the interim, what I have to do is I have to go for a bank overdraft. I ask for a bank for a very short term loan till my customers pay me. Just give me for loan for some time till my customers will pay for 2 months. But now, guess what? If the customers pay early, don't you think I will not have to go to the bank? That is called reducing financing needs. Okay, now take me through this. How have you understood this quickly? So if the customers pay early, yeah. What was the financing need? Why did I need money in between? Why did I need money? Very good. Absolutely. But why couldn't I get it from out of my business only? Yeah. I needed the money, but why couldn't I get it out of my business only? What have I given my customers that I'm not getting money from my customers right now? Exactly. Perfect. So can I say because credit sales was the reason why I needed financing? Had I done cash sales, do you think I would have needed financing? Why? Absolutely. Exactly. But because I've given credit, would I need financing? Yes. And now that my money is coming in faster, do you think I will need lesser financing if Angeline is paying me early? Instead of 2 months, Angeline is paying me in 1 week. Yeah, exactly. Now you got the logic? Okay. Next is credit policy. So longer periods may result from competitive credit terms. So why do you think people give 2 months? Do you think anyone wants to do a credit sale as a business? Do you think any business would want to do a credit sale? But they do it because exactly some people are doing it. Yeah. Yeah, yeah, go ahead. Mm-hmm. Exactly. Uh, yeah, you got it. Yeah, that's it. Okay. Looks like you pay attention in MCC when you were studying this chapter. Good, yeah. Good to see you catch. Uh-huh. Do you remember doing this in MCC anytime? Mm. So good, yeah. Superb. I love how quickly you're catching everything. Okay, that is about credit policy. Longer periods may result from competitive credit terms because your competitors are giving you better credit terms to the customers. You have to also offer it now. You can't do anything. Finally, cash flow. Efficient invoicing and debt strengthens the cash flow. So you have to ensure that you are invoicing efficiently means immediately goods are sold, you invoice it. Because see, credit period starts when the invoice is given. So you have to give the invoice immediately. If you give the invoice after 1 month, guess what? The money will come basically after 3 months then. Right? You have to make sure immediately give the invoice. Right? And debt collection. You should have good debt collection. You should have good people who can correctly collect the debt on time. Right? If the 2 months was the credit period, after 1 month only they should start making the calls. Let's see, in 30 days you have to pay us. Again, after 15 days, they're giving a reminder call. See, in 15 days, I'll come to collect money. Then 1 week before, they're telling, see, in 1 week, I'm going to come to collect the money. Regular reminders you're sending them. Right? If you have a good collection process, you'll see the money will be collected faster. Okay. So that is all about the receivables. All right. So let's just go through, yeah, these three ideas here quickly, Angeline. How have you understood this? Hmm. Hmm. Very good. Super. So that is all about the accounts receivables. So inventory is done, receivables is done. Now we'll come to our final friend, that is payables. So let's quickly close payables as well. Okay, let's try to get this here, Angeline. How do we understand payables? Super. Very good. So that is about how long we take to pay our suppliers, that is payment period. Formalize payables by credit purchases into 365 days. So we have made a credit purchase. So we have a payable because we have made a credit purchase. So payables by credit purchase into 365. So that is about this and supplier credit. So delaying payments provides like an interest short-term finance only basically because if I'm paying my supplier late, I have the money. Okay, you have the money basically, Angeline, to pay me. You bought some t-shirts from me and you have the money to pay me, but you're not paying me. Why? Because you need it in your own business, right? You need it in your own business. You also basically buy from me and then you sell it in various, let's say you sell it in various exhibitions. So now what you've done is you got the money, but you're not paying me. You're purposely using that money in your business only. But that money is mine. Technically, if you think about it, that money is for me. But you're not giving it to me. Instead, you're using it in your own business. You're putting two, three more stalls in your exhibitions by telling me that I don't have money right now. I'll pay you in 3 weeks. And you put off like three more exhibition stalls in your this thing, and you're basically using that money for your own self. So delaying the payments to your supplier, which is me, technically it's like a short-term source of finance for you only, if you logically think about it. Yeah, instead of paying me, what you've done is you've set off like three more exhibitions in three more stalls in exhibitions. You're selling clothes there, and you're making money. But how did you set up the stall in the first place? You're by not paying me. By not paying me, you got the money to set up those stalls. And then you made a lot more money in those stalls. Then you paid me off. They were like, okay, sorted. So you made off more money. But you just delayed my payment for 2 weeks and you made so much more money. Okay. So that is all about the supplier credit. That delaying the payments is in a way a form of interest-free short-term finance. An interest-free short-term finance. If you delay paying to your supplier, basically you're using a money that belongs to the supplier by not paying him, using that to grow your business and then paying them later. So that is a form of a short-term finance. The risk is basically the relationship gets spoiled. Next time I might not give you goods on credit only. Yeah. Because I'd be like, no, Angeline pays very late. So I might never give you goods on credit only. That is the risk. Your relationship will be spoiled. Second is I might give some early payment discounts also, early bird discount. That also you will not get. You will lose the discounts. I would have given like if you pay me within 3 days, I'll give you 10% discount. So you would not do, if you had done that, your let's say 1 lakh bill would just have been 90K. But now you'll still end up paying 1 lakh because you're paying late. So if you do pay late, you spoil your relationship with me. Also, you will miss out on the discount that I'm willing to give. Yeah. So that is about the risks. And finally, business should maximize the credit without harming the supplier goodwill. Make sure have a certain credit period where you're able to follow up on pay on that credit period. Don't delay just for the sake of it, right? Have a realistic credit period right from the start. So it keeps the relationship good. And the supplier will give you good goods for a long period of time. So we should maximize the credit, no doubt. Try to go as long as the person is ready to give you credit. But don't unnecessarily harm the goodwill and supplier relationship. Okay, so that is about this. So let's quickly look into here these four ideas here. How have you understood this? Yes. Yes. Yes, so that is the biggest problem with payables. Now that we've studied all the three receivables, payables, and inventory days, when you combine all the three, you get something called as operating cycle. So when you apply this in the formula, inventory and receivables are like assets, current assets. If you think about it, inventory and receivables are current assets, payables is current liability. So you add these two and you subtract the liability. So inventory days plus receivable days minus the liability, which is payable days, will give you the operating cycle. Okay, and shorter the better. This basically says how quickly does money go out of your pocket and how long does it take for it to come back inside your pocket. And if it's the shorter the better, that means quickly money comes back in your pocket. Okay, money comes back quickly into your pocket. So that is the meaning of operating cycle. So what is operating cycle? It measures the time between paying your suppliers and collecting customer cash. So how long does it take that for you to spend your first money and then get money in your other pocket? So from first pocket you take the money out, and let's say the same example that from first pocket you spend the money, you set everything up, you set up a shop, you buy, put some furniture, you get some pastries, so you have spent all the money, and then slowly you start getting people start coming to your cafe and then they start eating stuff and then you start getting the money. So how long does it take for you to invest 10,000 into your business and earn 10,000 out of it? How long does it take? That is called cash operating cycle. How long does it take for you to invest X amount of money and earn back that X amount of money? How long is that period? That is called operating cycle or cash conversion cycle. How long does it take for you to invest X amount of money and for that X amount of money to come back into your bank account? How long does it take? That is called cash operating cycle. Okay, that is called cash operating cycle. How long does it take for you to invest money and for that money to go back and come back to you in the form of customers buying products? How long does that cycle take? Like for someone who's selling samosas, so they buy the potato, they buy everything, whatever is needed, the oil, the utensils, and everything, and they make and they invest X amount of money. Let's say 10,000 rupees they've invested, and they make the samosas, and then they sell it out, and how long does it take for them to earn that 10,000 rupees back by selling the samosas? That is called cash operating cycle. So you add the inventory days and the receivable days, you subtract the payable days, shorter the better. It says money comes back faster to you. So the less funding you will need, funding needs will be reduced because you don't have to take overdraft from the bank. And if it's shorter, it says that your business performance is very efficient. And you can compare it with the previous year or with your competitors as well. Okay, you can compare it with previous years and see how are you improving year on year. Okay, so let's go into the meaning formula and what would you ideally like it to be. Let's look into these three. Yes, perfect. Yes, and liquidity in simple words basically means that how much cash do you have available to perfect to pay any short-term liabilities? How much cash is readily available with you to make any to cover your short-term expenses? That is called liquidity. If you have more than you need, they say you have very good liquidity. If you have less than you need, obviously it's not a very good liquidity position. So how much current assets you have to pay off your current liabilities. So that is basically about that is a cash conversion cycle. First we looked into inventory, then receivable, then payable, and then brought all of them together and we understood the cash operating cycle. Okay, just have one good look here, Angeline, see if there's anything that's confusing. Are we clear with this? No, okay. Now we'll look into time multiple. So what we'll do is either you use 365, 12 or 52, whatever is appropriate as per the question. The time multiple, whatever is given in the question, based on that you solve. And we will see as we do some questions here. And use average inventory. Always use average balances whenever possible. As much as possible, go for average balances. Don't use the full balance. The average means like starting plus ending divided by 2. So inventory, what was your inventory at the start of the year? Inventory at the end of the year divided by 2. Receivables at the start of the year, receivables at the end of the year divided by 2. Payables at the start of the year, payables at the end of the year divided by 2. As much as possible, always use average balances. Right? That will give you a more realistic answer. Okay. Just use like an average start of the year plus end of the year divided by 2. but they'll be given in the question 99% of the times. Don't worry. Okay. Closest figure. Use reasonable substitute if exact figures are unavailable. Okay. If exact figures are not there, just use very reasonable figures. Comparison. Always compare ratios with trends or industry benchmarks. Always compare ratios with industry. So once you calculate a ratio, it doesn't mean anything. You have to compare it with something. Always compare the ratios with trends or industry benchmarks. Always compare the ratios with trends or industry benchmarks. An exam technique. State assumptions clearly when estimating figures. If you're using an estimated figure, state it clearly. If you're using an estimated figure, state it clearly. If you're using an estimated figure, use it clearly. Okay, so what is time multiple? Use 365 days, 12 months, or 52 weeks as appropriate. Whatever's working out for you, use that. Average balances, always use an average. Closest figure, use reasonable substitutes if exact figures are unavailable. Comparisons, always compare ratios with trends or industry benchmarks. Exam techniques, state assumptions clearly. If you're using an estimated, just make a note of that and just let them know that you're using an estimate. You don't have the exact numbers. Just put it in writing there. Always do the comparison. And if you're not getting exact numbers, use the closest numbers. As much as possible, use average numbers. That's it. Okay, so let's go through these 5 points here on this one, yeah, Anjali. Yes. Yeah, stated assumptions. If you're using an estimation, just state it. That's all. So that is about this. But there are some limitations of working capital ratios. So let's look into what those limitations are. Okay, first is point in time data. These are based on balance sheet values on one date. Now you only take the numbers that are there in the balance sheet at the end of the year. End of the year, your receivables was 5,000, payables was 2,000, inventory was 3,000. So you're using only end of the year figures. But that doesn't tell you how the entire year was. That imagine your entire year was very good, and in the last month, everything bad happened. Your inventory went down, receivables also went down, and payables went up due to something that happened in the last month of the year, like in December. So it will give you a very bad ratio. But entire year was good. So if you technically think about it, does not give you a complete picture, a realistic picture of the entire year. It is just based on the number that was there at the end of the year. Right? It just gives you a ratio based on the numbers that were there at the end of the year. It just gives you a ratio based on the numbers that were there at the end of the year. It just gives you a number based on the ratios that were there at the end of the year. So that is called point in time data. That again, it just uses all the information as on one date. It doesn't tell you the story of the entire year more realistically. Next, business can manipulate because see, you need numbers only at one point in time. So you can definitely do something and manipulate it. Last year, somehow you'll try to manipulate everything because you need number only at one point in time. So you'll try everything to just manipulate it somehow. Like we all do for attendance is needed for only one semester. So towards the end, we try to give medicals and everything. Somehow we try to manipulate the result. Same thing happens there. They also try to manipulate the result. Historical, the ratios reflect past performance rather than future. It doesn't tell you anything about the future. It just tells you how the past year was. It doesn't tell how the next year will be. It just tells you what the past year was. Next, inflation impact. Inflation and growth may distort ratios. So a lot of times you may not have done a better performance, but because everything's prices have increased, it will make your performance look good. This year you were selling everything for 10 and you sold around 25 units. So you earned 250 rupees. Next year, same thing. You sold 25 units only, but your selling price increased to 25. Right? You're selling 25 units only, but this time you started selling it for 25 per unit. So now your sales have become 625. See, last year also you sold 25, this year also you sold 25. Only that you have increased the prices doesn't mean your performance is better. Last year you sold one good for 10. Last year you sold one goods for 10 and you sold 25 units. So totally you sold worth 250. This year what is happening is you're selling the same 25 units only, but your selling price has increased to 25. So the total that you have sold is 625. The total you have sold is 625. So if you see, you'll say, wow, that's a huge improvement. But if you think you have not really sold much, you sold the same only. It's just that your selling price have increased because of inflation. You have increased your selling price. You're still selling the same quantity only. Okay. If all else, I would say, or let's say you just sold the same 250. But if you think here your sales have actually reduced. Imagine now you're selling. Now you're selling only 10 goods, right? Before you used to sell 25 at the price of 10. Now you're selling only 10 at the price of 25. And you're like, okay, the performance is the same. But if you think about it, now you're selling less actually. Before you used to sell 25, now you're only selling 10. Right? Before you used to sell 25, this were the units. So before you used to sell 25 units, so you earn 250 bucks. Now you've sold only 10 units. It's just that your selling price has inflated because of inflation. Your selling price has gone up. But you're basically selling less if you think about it. So sometimes inflation will manipulate your result. Inflation stops you from giving a clear picture. Okay, and finally, context matters. You have to compare your ratio to something. You just simply cannot just calculate the ratio and be like, yes. You have to compare it to something always. Either you compare it to a past year figure or you compare it to your competitor. But you need to compare it with someone. But you need to do what? You need to compare it with someone. Right? You should always be interpreted alongside other information. By it in itself, it's not going to give a very clear picture. You have to compare it with the last year figure or you have to need some more information to make sense of it. Context becomes very important here. So that is the limitation of working capital. Okay, it only shows you past date information. It gives you a description about the past year data. It doesn't give you a description of what the future is to come. Okay, it reflects only past performance rather than future results. It reflects only past performance rather than future results. It only reflects past performance. Okay, so let's look into this here. All the limitations once, Angeline. How have we understood it? Simple words. Hmm. Exactly. Mhm. Yes. Mm. Mm. Perfect. Benchmarks would be like past year data, this year data, things like that. No, okay, great. Yeah. Got the total clarity on this as well. Now we look into some formulas. So we look into working capital, turnover. So you take working capital and turnover. So turnover basically means sales. So you do sales. Whenever you see the word turnover, 9 out of 10 times it is sales. So sales revenue and then working capital is assets minus liability. Sorry, current assets minus current liability. That is called net working capital. So working capital turnover. Turnover basically means how efficient working capital generates sales. So you take sales revenue divided by net working capital. Now, how do you get sales revenue? It's a number directly given. Net working capital, current assets minus current liabilities. You get your net working capital. Next, higher ratio. A higher ratio, the better. It indicates more efficient use of working capital. Like for example, if I gave three people laptop and I gave them 3 months and they all were writing an ACCA exam, right? One internet connection, one laptop, and 3 months to prepare. Not everyone will have the same marks. Some will score a lot, some will fail, some will just pass, some will score average, some will get a rank. Right? It's the same time, it's the same laptop, it's the same internet connection. Similarly, the working capital, if I give 100 rupees working capital to three people, not everyone will make the same sales. Some will make a lot more, some will make a lot less. So it comes down to if the same thing was given to you, how much more did you make out of it? If the same thing was given you, how much did you make out of it? Okay. If the same thing was given to you, how much did you make out of it? If the same thing was given to you, how much did you make out of it? The same thing, how much sales were you able to generate from the working capital? How much sales were you able to generate from the working capital? How much sales you were able to make from working capital? Okay, how much sales you were able to make from working capital? Very important. How much sales you were able to make from working capital? That is what your working capital turnover is. How much sales were you able to make? Okay. So a higher ratio indicates more efficient use of working capital. If you use working capital efficiently, that means you'll have a higher ratio. So how well are you using your laptop in your ACC exam? Three students registered for an ACC exam. All the three students had the same teacher, had the same resource, had the same time. Everything same. Yet few students got a very good mark, the others did not get a very good mark. Why? Purely because of the fact that some did not use the time and the resources and the teacher as well. See, right now you're attending sessions, a lot of students are not. So you're utilizing the teacher well, you're utilizing your time better. So you might tend to get a little higher score than others. That we could say that your turnover is higher. Your similarly, working capital has been invested into a lot of companies. Not everyone can get the same amount of sale. So how much sale can you get from your working capital? How well are you using your working capital to generate sales? So that is the meaning of working capital turnover. That how well are you using your working capital to generate turnover? Turnover means sales. How well are you using your working capital to generate turnover? How well are you using your working capital to generate sales? That is sales revenue divided by net working capital. So always remember working capital is again your assets minus liability and your current assets minus current liability. And turnover means sales. So when you read this only, you should know what and all will come here. Working capital means your current asset minus current liability. Turnover means sale. This numerator denominator is something that you will through revision you will remember it. Sales revenue divided by net working capital. Now, okay, next higher ratio. Higher the better, obviously. But the more sales you can make, the better. Over trading indicator extremely high also will suggest that may suggest insufficient working capital. So extremely high is also something that you need to watch out for. If it is marginally high, it's still good. But if it's extremely high, may suggest that there is insufficient working capital in your company. You don't have insufficient working capital. And interpretation analyze alongside working capital ratios for meaningful conclusion. So you should always compare this alongside working capital ratios. Okay, alongside working capital ratios, you should try to look into this. Okay, so firstly, we understood our working capital ratios and operating cycle here. Okay, just have one good look here, Anjali. Is there everything clear about this? Okay, then we looked into the 3 days and we got the topic introduction of your inventory, receivable, payable days. We understood cash movement and what is the ratio really. So nothing difficult here. Inventory holding period, we understood that what is inventory holding period, what is the formula, and what is better, lower or higher. Then we broke it down from a retailer perspective and from a manufacturer perspective, what will be the total inventories. Collection period, we understood what is better, shorter or longer. In accounts payable period, we understood here payment period formulae. Next, that payable is basically how long we are taking to pay our supplier. How long we are taking to pay our supplier. Along with that, we looked into the formula. Then the credit supplier, we looked into risk and balance also, we looked into that. So this is about a payable. Then we brought together all the three ratios and we have understood the cash operating cycle and shorter the better. Then a few simpler things over here, which balances to use and how you should do the comparison. Some limitations over here. That is point in time data. You can manipulate it. It tells you about the past only. Inflation will distort the results. Then working capital turnover. What does it mean? Turnover means sales generally. So working capital turnover means how well are you using your working capital to generate sales? How well are you able to do it? So that is your working capital turnover ratios. Okay, so now what we look into is to see if there is any questions that we can solve based on how much we were able to get a grasp over today. We should be able to finish this chapter tomorrow itself. It's a very short one. Not many questions here. Working capital, we looked into working capital aspects, cash flows. Okay, this we will be looking and continuing in the next part here. Okay, we have all of this, the coming parts. So based on whatever we have been able to accommodate, we have finished the this part. Okay, so this is all done really well. Okay, so again, tomorrow we'll look into the various other aspects of working capital. And that's pretty much, I would say, the last theory chapter that you will find in. Not this is also not theory, but there's certain theoretical aspects to this chapter. It's pretty much the last that you would see because after this, it's all sums, and sums. Okay, so that is for the first part of chapter 7.